What we want to do is give the investors their capital back so they can do whatever they want with it. But I would submit that reinvesting it is probably the smart thing to do. And then we have that income stream. Every 5 years or so, we're going to do another cash out refinance.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name's Randy Smith, and I will be your host today. And I've got a good friend of mine, Brian Briscoe, with us today. Brian is the president and CEO of Streamline Capital Group, which is a multifamily syndication group that focuses on long-term holds. We'll get into that. He is also the director of the Tribe of Titans, which is an education platform that teaches folks how to do what he does. And he also was in the Marine Corps for 20 plus years. But from what I understand, once a Marine, always a Marine. So I suspect that's the case for you as well. But Brian, welcome to the show.
Hey, thanks a lot, Randy. I very much appreciate it. And I just got to say publicly, I've already told you this like 24 times. I love the name of this podcast, Gentle Art of Crushing It. Love it. Well done.
It is. It is a strategy of finesse, I believe, to go out there and crush it. So I've been told in the past that I can kind of be a bull in a china shop. Mm-hmm. So I need to kind of smooth those edges a little bit. But, it is fitting. Well,
I mean,
Brian,
it makes it sound like you're using a vice to crush things instead of a hammer is what it is. And just like, you know what, we're going to gently crush this thing, but we're still going to crush it. Yeah.
We're still going to crush it. Yeah. Like I love the sign above your head, hustle as a verb, the most important word ever. Love it. Well, why don't we jump in? Can you tell us a little bit about yourself, more than, the high level overview I gave, and how you found this amazing space?
Well, I think, typically the story starts, born and raised in Salt Lake, and we'll come back to that later. But Salt Lake City, Utah, ended up going to the University of Utah. That was the hometown school. Got a bachelor's degree, master's degree, and I wanted to be a college professor, and I wanted to do math, which was crazy. Right now I think it was crazy, but at the time I didn't. Started a PhD program, and like 2 weeks into it was September 11th. And basically I decided that I'm going to take a brief pause from the PhD program and go join the Marines. And that's what I did, but never went back to grad school after that. It was just kind of like I think I realized I didn't really like math as much as I thought I did, but that there was a lot of, I'm not gonna say pleasure, but I enjoyed being a Marine enough to do it for 20 years. We'll just put it that way. I ended up buying single family homes along the way. I mean, I moved 10 times in 20 years. And so you have a lot of opportunities to buy homes as an owner occupant, which gives you better interest rates, easier qualification standards, lower down payments, and blah, 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 right? All that stuff. So my model was every time I move, I was going to look at, buying a house. And my one metric was, what is my mortgage versus what are the rents around here? And everywhere I moved where rents were higher than my mortgage, I bought a house, right? And so that's what got me into it. And I found out that I was passionate about real estate. I loved real estate. All right. I can't really say that I loved math as much as I could say that I loved real estate. So I started trying to figure out, how can I turn real estate into a career? And I don't want to sell. I wanted to own. I wanted to buy. I wanted to, do all that stuff that, could replace my income. So long story short, I ended up getting into a coaching program to teach, how to do multifamily, like from an operator standpoint. So my route into multifamily was very active. It was very hands-on. It was, finding the properties that I want to invest in and get them under contract, and then find other people to invest with me. So um, that was really what I was aiming to do, was um, build that up to where I could replace my active duty income. So I started when I had about 3 years left in my um, 3 years left till retirement. And the way military does retirement, it's like a light switch at 20 years. It's off, and as soon as you hit your 20-year mark, it's like, congratulations, here's a pension, right? Um, so yeah, I 3 years out from that, the day I could get my pension is when I really started. And so I was just, like the sign behind me says, I was hustling. I was working at the Pentagon, sometimes in that building for 12 plus hours a day, and then nights and weekends it was 100% real estate. So that's how I got into it. Started doing a lot of fix and flips with multifamily, and it's not like a single family home where you can fix and flip it in a month or two. It's a year or two as far as that goes. But we did a lot of shorter term holds. And just over time, I just started, my mindset started shifting, and yeah, we were making money, we were making our investors money. But I always cringe when I see one of our old properties come back in the market at much higher price. And um, end of the day, I think when you look at wealth building, when you look at passive income streams, which is what I want, and I think what most people are trying to get. I think in real estate space, you really have to lean towards those longer term holds. So yeah, that's kind of like the instead of the 30,000 foot view, maybe the 10,000 foot view, and how I got into what I'm doing.
Are you interested in real estate investing but don't know where to get started, or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Awesome. Well, thank you. And first of all, thank you for your years of service. I appreciate that. I know our listeners do as well. So thank you. Um, you mentioned about 3 years prior to your um, ultimately stepping away from the military and getting your retirement there. You started this education process, or started getting involved. What did that look like for you? Did you join a mentorship right away, or was it books and podcasts or CDs, or
Oh
what was it
yeah.
at that point?
It was honestly about a year's worth of podcasts, and
Okay.
every time I was commuting, all my gym time, I was listening to a podcast or, something on Audible, an ebook or whatever. But
Yep.
um, I remember the summer that I was moving between San Diego and DC. I was staying at my in-laws' house, and I didn't know where I wanted to invest at this point. I just know that I did, and
Sure.
I started thinking, you know what? I mean, my in-laws live in Idaho Falls. That's probably a pretty good place to start. And
Okay.
um, didn't know I'd ever live here. That's where I live right now. But I
Sure.
remember touring, just calling a local broker, and I remember touring a couple of multifamily properties. We're talking like 6, 8, 10 plexes. And I remember walking out of one of them and just thinking, I don't even know if this is a good deal, or how to even
Yeah.
determine if it's a good deal. So
Yeah.
after a year of binge listening to podcasts, I just like, I don't even know how to look at the numbers on this thing.
Hmm.
And so that's really what drove me towards the more hands-on learning, and that's what got me into a full mentorship program. So
Okay.
really what I was looking at is, how do I run the numbers? I mean, I'm a math guy, so I
Hmm.
can run numbers, but I didn't know what numbers to run. And so got into the coaching program, kind of one-on-one mentorship. Um, and yeah, that ended up working out pretty well for me.
Sure. So now, for the listener, and our listener is the newer passive investor. I'm curious, can you talk about, like, was that a pretty hefty financial investment?
Mhm.
Was there a huge time commitment that was involved with that?
Yeah.
Like, what would somebody expect if they were to
Mhm.
kind of follow in your shoes?
Yeah, I mean, the financial commitment, I would say, coaching programs like that range between 50 and 15 and $50,000, so, most of them in the multifamily space are 12 months long. I don't think anything less than 12 months would really work. So yeah, I mean, depending on your finances, for me, it was a pretty big financial commitment. I paid 25,000. Um, Fortunately, my wife was very supportive, and when I told her what I wanted to do and how much it was going to cost, her response was, "That's cheaper than a master's degree." And I'm like, "You're right, it is." And she's like, "Yeah, I mean, if you're do it," is what she said. So, I mean, we had just recently sold one of our single family homes, and we had the money in the bank, so it was just yeah, I mean, we were able to just pay that outright instead of, doing like the credit card method or whatever. But as far as time commitment, I mean, the people who run those coaching programs will let you not do anything. But if you really want to do it right, I would say 8 hours a week minimum, and that'll put you on a path where you close something in a year. But I was putting in a couple hours a day, usually after the kids went to bed. Couple hours, on the weekend. Usually like a 4 hour block Saturday morning when kids at home were still kind of being lazy. Um, but yeah, I think the time commitment you got to put in the time is the answer. You got to put in the time.
Yeah, and so I asked the question because it's I think a lot of people think you can get into this space and you just kind of hustle a little bit on the side and all of a sudden you're going to start getting these huge checks. And it is a lot of work. It's a lot of
Yeah.
dedication. There's a lot of stub fingers and toes along the way, and a lot of mistakes occur. Um, and it is not just make a decision
Mhm.
and your first dollar's going in, you're going to multiply right away. It can take a year plus before you start to see anything from an
Yeah.
active investor standpoint. Okay.
It took me, I would say it took me 3 years, and this was my goal. And part of me wishes I made a bigger goal, but
Hmm.
at the time I was focused on replacing my active duty salary, and
Yeah.
um, I set my date as October 31st, 2021, because that was the day that I was eligible to retire. And
Ah,
um, so I focused on that goal. I focused on that timeline. It was like they say, the SMART goal. Yeah, I had a timeline. It was achievable. I knew exactly what I was looking to do.
sure.
And, with a lot of hustle, I actually almost exactly replaced my income in 2021 with multifamily investing. 2020, I
Fantastic.
didn't make a lot. 2019, I didn't make a lot. 2018
Okay.
is when I started the program. But yeah, from 2020 on, I've done very well. But yeah, it took
And
me probably 2 years to ramp that up.
and so was that first 2021 in October,
Mhm.
did you sell an asset then, or had you created like monthly income from the operations of these entities that you were buying?
We did a couple of different things. I mean, we had some
Okay.
acquisition fees come in. We actually brought a new partner into the partnership as well, and he paid some of the equity. Paid us for the equity. Kind of bought some shares in as well.
Okay.
And then right after that, we started selling a couple of properties. Like I said, we were doing these shorter term, 12 to 18 months, and so I don't
Yeah.
think our first one sold just into 22. And so, yeah, I mean, it was a combination of things, but I would say as an active investor, the income usually comes in big chunks.
Okay.
It's acquisition fee on the front end, and it's your carried interest on the back end. So when you sell the
Okay.
property, we would usually do like a 75-25 split, and that our my portion of that 25% of the profits is what was really putting money in the bank account. So
Love it.
acquisition fee on the front end, usually a 5 figure number, and on sale, five or low six figures is usually what I'm getting on sales.
Okay. Okay. So 2021, you hit your target, you're retiring at this point, and now you jump in full time and
Yeah.
you can dedicate 100% of your time. I suspect that things started to explode at that point. Was that the case or
Actually, you know what? I expected it too, but that's not what happened.
okay?
we had a lot of friction. I had a partnership. We had this exclusive company. There was a lot of friction inside the company, um, and I ended up leaving the company less than a
Mm.
year after I retired. So it ended up being kind of a start all over from zero type thing.
Sure.
So yeah, I mean, just like I said, there's just a lot of friction. We wanted to go different directions, and nobody, that there wasn't a lot of let's try to work things out,
Yeah.
involved. So
Interesting. Yeah.
yeah, I mean, it should have exploded, and I really thought it was going to, but so yeah, I mean, fortunately, there was still enough money coming in where it was about a year ago next week. It was the first week of July last year that I officially split from the company.
Okay.
It was like a 3 month process getting out, but I mean, just with all the legal stuff. So
Wow.
long story short, since then it was sit down, refocus, figure out what I really want to do,
Hmm.
and then launch. And so that's what ended up happening. I wish that it was hit the ground running and just start to sprint from there. But
Got it. That's not always how things work out,
yeah,
obviously. So
yeah,
interesting.
yeah,
Okay. So now, before we got on, you and I talked a little bit about kind of your focus today and what you're working on
yeah.
being long-term hold in the space
Mhm.
versus this shorter window flip strategy that we see many value add folks doing. Can you kind of help educate the audience
Mhm.
on like what's the difference? Why would
Yeah.
you want to do one versus the other? Are there benefits of both strategies? I'm curious your thoughts there.
There are definitely benefits to both strategies, and I think the easiest way to explain it is it's risk versus reward. There's a little bit more risk with the short term holds. So if you're doing the short term hold, like I don't know, if you would have bought something a year ago expecting to turn around and flip it in 12 to 18 months, you might lose money, right? And
Hmm.
so on the flip side, flip side pun, and yeah, that was pretty punny.
Sure.
But sorry, yeah, I just saw that shiny object squirrel syndrome. But
Sure. Yeah. A punny
yeah,
response. I like that.
on the
Yes.
flip side, buying anything in 2020 or 2021 and waiting a year, I mean, you could walk away with a seven figure income. So
Sure.
there's more market risk with the short term hold model,
Okay.
and there's also a lot of risk with you have to be able to execute, you have to be able to get renovations done. um, so anyway, there's more risk with the potential of a slightly higher reward. When you do the long term hold, you can still get all the advantages of the forced appreciation. I mean, I can buy the exact same asset
Yep.
as in a short term hold, and then instead of selling it, when we're done with our renovation process and we have it stabilized, I just refinance.
Yeah.
Right? And so what that allows me to do is give the investors, typically we're going to time the refinance to where we can give the investors 100% of their capital back. So if they invest $100,000 with us, when we refinance, they're getting that $100,000 back.
Yep.
But we're not buying them out. We're going to keep them in the deal at the exact same ownership percentage. And this is where we really start building passive income, these streams of income,
Yep.
which with that other method, with the shorter term holds, you might make a higher return number, but while we're doing the renovations, it's not cash flowing. It
Hmm.
really isn't. Um, Unless you buy a unicorn, but
Hmm.
you're taking units down, you're increasing your vacancy intentionally, you're decreasing your cash flow intentionally to do all the renovations. And so what you end up getting with the short-term hold is nothing, 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 nothing. Okay, now we sell it. Now you get a bunch of money back.
Yep.
So that's not bad. All right. I'm not saying it's bad. It's just a different investment philosophy.
Yep.
So what we want to do is give the investors their capital back so they can potentially they can reinvest it, do whatever they want with it. But
Hmm.
I would submit that reinvesting it is probably the smart thing to do. And
Sure.
then we have that income stream. And every 5 years or so, we're going to do another cash out refinance,
Hmm.
which means not a taxable event. All
Hmm.
right, we'll do another cash out refinance, put another chunk of money into the investor's pockets,
Yep.
and keep that income stream going. So I think it gives you the best of both worlds. It does give you, these large capital events every, 3 to 5 years, depending on where the market's at. But it also allows you to build income streams. And if you start stacking that, I mean, if you put 100,000 in today, we do our value add, and 3 years from now, refinance, give you all your
Hmm.
money back. You can do that again and again and again.
Yep.
And, with that same $100,000 investment, 5, 10, 15 years from now, have yourselves, 8, 10, 15, 20 different income streams.
It's
So,
amazing.
yeah,
Yeah, absolutely amazing. Yeah, and it creates different taxable situations and tax advantaged incomes as
yeah,
well by doing that strategy. As you mentioned, that it doesn't create a taxable event when you do the cash out refi.
yeah,
I'm curious though, on the back end, say you do buy a property and you hold it for 10, 12, 15, 20 years.
yeah,
If you're doing these cash out refis on a regular cadence, at the end when you sell, is it essentially like a surrender of the capital, or is there a huge tax bill that ends up coming at the end, or what does that look like? And I know, of course, you're not a
yeah.
CPA. We're not giving tax advice or anything like that, but
So
I'm curious
yeah,
in application.
I can't tell you what the individual cash or the tax bill is going to look like. 'Cause, yeah, I'm not a CPA, and everybody's tax situation is different. The capital gains that you get, I mean, your basis is going to be, near zero by that time. And so there's going to be a very large percent of capital gains on that. So
Okay.
that's something that is one of the downsides of it. But with tax planning, you
Hmm.
can usually mitigate that by quite a bit. There's
Yep.
lots of different ways to mitigate that. Um, so that's something that just has to be planned for. And if you know it's going to happen, far enough in the future, you set up things right. And one thing we can't control is legislation. Right now there's
Right.
bonus depreciation, accelerated depreciation. If those laws still exist, 20 years from now,
Hmm.
um, you know, a lot of times you can offset, depending on your tax situation, you can
Hmm.
offset a lot of those gains by, reinvesting proceeds and further depreciating
Yep.
in depreciable assets. So
Yep.
it is definitely. I mean, if you look at the one drawback of that method, it is the fact that after 20 years of holding a property, you have depreciated it almost all the way to zero, and so
Hmm.
there is going to be a larger tax. Uh,
But it
yeah,
seems like you could also 1031 into a future cash flowing deal
yeah,
and basically 1031 till you die, right? And
yeah,
then the tax basis dissolves, and if you hand it off to a survivor,
mhm,
then the tax benefit just
yeah,
flows right over to them. So yeah, okay. Well, very good. It's unique, and as a very heavy passive investor myself,
mhm,
it's not something I participated in yet, but I love that idea of the cash out refi to give me my money back, so I could go place that in another deal, gain some more passive losses again, mix and repeat over and over and over again, and essentially you're just multiplying the returns that you can get
mhm.
out of that same hundred grand that you initially invest. So
And if you're a bigger pockets fan, we're doing the BRRRR method on
yep,
multifamily. That's all it is.
yep,
It's not
exactly.
new, and it's actually how people have been investing in real estate for centuries. So
Yep. And how the truly wealthy acquire the wealth that they do and get all the tax advantages that we hear
absolutely,
on the headlines every night. So
yeah,
okay, well, very good. So yeah, that's exciting. I'm intrigued. I want to hear more. I want to see the deals. So you and I will connect outside
absolutely.
of this to do that. I would like to, if we can, shift a little bit. You mentioned you're focusing solely on Salt Lake City now.
Yeah.
I'm curious why Salt Lake City,
Mhm.
where you think the market is. What do you think we might see in the next 6 to 12 to 18 months?
Yeah. So when you do real estate's local, I think um, you have to focus. I mean, a lot of people talk about diversifying and things like that. I I think you have to focus. You look at a lot of people that are extremely wealthy, and it's because they have focused on something. Diversifying is a way to protect your assets, not to grow your assets. So, when you start looking at, what focusing on one single market does, is you get a lot of relationships and you're going to have access to deals. So maybe the first, first year or so is going to be a little bit more difficult for us because we are focusing in just one market. But as those years progress, we're going to have, a stronger reputation. We're going to have stronger relationships. We already have, one broker that is calling everybody he knows that owns a property that is inside our buy box, right? So, the more and more time we spend in that market, the better reputation we have, the more first looks on deals we're going to get. All right. And the more off market opportunities we're going to get. So I think when you look long term, focusing on one market is a much better strategy than, going wherever the wind blows. And there are a lot of people, once again, that's it. I'm not saying one is good or bad. There is a lot of goodness, if you're going from, hey, you're using the data to say, hey, Houston's the hot market this year, let's go invest in Houston, right? So there's a lot of positives on doing that, but I think long term, and once again, I am more of a long-term investor. I think long-term, that's the best strategy, is to focus. And as far as where Salt Lake City is going, I'll just point U.S. News and World Report. In April, they did their annual state rankings. Utah was number one overall. They were number one in economy. They were number one in population growth. They were number one in job growth and projected economic growth. Okay. US News put them number one in all the categories. Now, that's the state as a whole. The greater Salt Lake City area has 90% of the population. So you look at where all that growth is happening. You look at where, both population and economic growth is happening. It's in the greater Salt Lake area. So where is the city going? Right now, they're on top of the stack. Okay. Number one in the nation. So now all these numbers are per capita. So your Houstons and Dallases are going to get a lot more people per year. Per capita growth, Salt Lake, the greater Salt Lake area is still on top.
Absolutely. And there is a technology hub
Mhm.
south of Salt Lake City
Yep.
that is significant.
Mhm.
Having spent a number of years out there for family
Yeah.
and business as well, it's just absolutely exploding. And you drive,
Mhm.
I think, is it I-15
Yep.
from Provo up to
Up to Salt
Logan?
Lake, yeah.
It is just absolutely exploding
They call
all
it
along that corridor.
Silicon Slopes. It's kind of a play
That's
off of
it.
Silicon Valley. And I mean, the biggest terrain feature in that's a very military terrain feature, but the
Yeah.
mountains. I mean, you have, and a lot of these tech companies are right on the foothills and the benches of the mountains. And so,
Yeah.
speaking of tech company growth, I'm going to wow you with another stat, but the
Okay.
U.S. Chamber of
Perfect.
Commerce said that the state of Utah is number one in tech company growth as well. So
Interesting. Okay.
even in a time where tech's not doing great nationwide, it is booming in Salt Lake right now. But it
Yep.
is you. I mean, you were a little more geographically precise. Most of the tech scene is just south of Salt Lake City. It's Utah County,
Hmm.
north of Provo. It's between Provo and Salt Lake City.
Yeah. Yeah. Beautiful. Yeah, and it's a really great place to visit, fun place to come as a passive investor to go to conferences and see beautiful
Mhm.
properties and hit the
Yeah,
slopes, whatever it is.
go
So yeah,
skiing, go mountain biking. I mean, there's lots of national parks. It's an outdoor mecca,
yeah,
unless you're looking for an ocean. But it has,
right.
yeah. So,
Yeah, very good. Well, good. So Salt Lake, yeah, I know Salt Lake has been booming for years,
mhm,
and multifamily. I think the fundamentals are still extremely strong. We're going to have an affordable housing issue for probably decades to come.
mhm,
So I think you're picking a great space. So now I know when we were talking earlier, you mentioned or I mentioned that you're the director of the Tribe of Titans.
yep,
I know you're an educator at heart, but
mhm.
tell me a little bit about that. I'm curious if folks wanted to either find you and learn from you or become part of Tribe of Titans, what would you suggest? Where would you point them?
Just reach out to me on LinkedIn. I mean, send
Okay.
me a connection request, send me a DM. That's where I'm more likely to respond. But yeah, send me something on LinkedIn. But I mean, you are right. I'm an educator at heart. I think my previous career, where I wanted to be a math professor, was because I like teaching. All right, I
Hmm.
happen to be good at math, but this puts me in a space where I'm teaching something I'm passionate about. I don't hire. Well, I'll eventually hire some other people to help with the teaching aspect, but
Hmm.
I do private coaching for people. I have a limit to the number of clients I'll take at one time.
Hmm.
But there's also a kind of a subscription based portion of this where you can get in, you can be part of the group, you can learn. There's a lot of content in there. I do live streams inside the tribe. It's all on a really cool app that you can put in your pocket. So
Love
um,
it.
yeah, so
Yeah.
that's it. And LinkedIn is by far the best way to reach out and to get into that.
And if the listeners go to any conference in the entire United States, odds are you're going to run into Brian. I've seen you at, I don't
Several.
know, 3 or 4 this year, I feel like already.
Yeah.
So
I,
yeah,
I
but
am I am a little bit conferenced out. It's kind of
yeah,
like, what, do I really want to go to another one right now?
I get it.
Yeah, so it might be another month or two before I buy another conference ticket. But
Yeah.
yeah, the first half of this year, I think I hit 8 conferences in 6 months. So
Yeah.
we're
Well,
slowing down.
I think that's important for passive investors
Mhm.
to know and realize is that the people that are really doing big things in this space and the people that are generally good stewards of your dollars, they're constantly getting educated, they're
Mhm.
constantly upskilling, and they are out there amongst all of the regular investors just learning more and more and more. And
Yeah,
that's one thing, Brian, I really respect. And I believe podcast world as well. You're out there a ton in the podcast world.
yeah.
So I appreciate that. But well, very good.
Thanks.
Well, anything else you'd care to share with the audience before we kind of jump into our final questions?
Let's see. Speaking of the education space, I am going to be co-hosting. I think this is perfect for your audience. I'm going to be co-hosting a passive investor conference in the fall, since we were
Okay.
talking about conferences and education. But the dates, we haven't set the dates up yet, but it's likely to be third or fourth weekend in October. But it's
Okay.
going to be free, which is awesome.
Wow.
Yeah.
Fantastic.
Yeah, I mean, there will be upsells. If you want the recordings, you're going to have to pay a little bit for it. But just to attend,
Sure.
it's free. It's all virtual. But I think that's going to be a great event for anybody interested in passive investing.
Got it. So follow or connect with you on LinkedIn, and we'll
Yep,
definitely see
absolutely.
the announcements then.
You'll
Okay.
see it. Yep.
Very good. Well,
Mhm.
let's jump into kind of we have 3 questions that we like to ask everybody
Okay.
on the show. One is just kind of the generic, like what is, or what would you say is probably the best educational resource out there for the newer passive investor, whether it be books,
Mhm.
podcasts, conferences, whatever it is.
I would generally say, and this applies to just about everything, is talk to people who are doing what you want to do. Okay, that's it.
I love it.
I mean, people who are selling you something are going to sell, right? But if you're interested in passively investing in X, go find somebody who's passively investing. You know,
I love
if
it.
you talk to me about multifamily, I'm going to tell you it's the greatest thing in the world.
Of
But
course.
go talk to somebody who's on the other side, who's investing passively. Now, I mean, I invest passively myself, but I'm also
Yep.
looking for people to invest with me as well.
I think that's great advice. That's great advice. I say it here all the time. If you go to the barber shop, you're going to get your hair cut.
Yeah.
So be careful where you go or who you ask. So great advice. Let's see here. We've already talked about how to find you and reach you. So any recent bucket list items that you've checked off your list, or any that you're hoping to in the near future?
Bucket list. Yeah, I probably should. I think last year, I took the month of November off. And that was fun. It was just
Yeah,
one of these things where, that's what investing has done for me. It was just, I was kind of like in between partnerships, hadn't figured things out. It was like, you know what?
I love it.
We went to Florida, spent a week doing like the Orlando, the Universal Studios and all the theme parks, and
Yeah,
spent a couple weeks in southern Utah doing four wheelers and everything else. mean, that wasn't necessarily on my bucket list, take a whole month off and just have fun with the kids. But I think I'm retroactively putting it on the bucket list and checking the box. So
I love it. Yeah,
yeah.
no, and it is like the freedom you can get from
Mhm.
either passive or active investing in real estate is just amazing. And it does have seasons where you can make the decision to completely step away if that's what you wanted to do.
Mhm.
And I think it's a great idea to reset and
Yeah.
realign and put the new plan in place and charge forward like you've
Yeah.
obviously done. So
You know, I was
very
going to say,
good. Well,
big bucket list item right now is when I started in multifamily, I always imagined myself as like the CEO of an organization, and I got into a partnership that was an equal partnership. And that, part of the reason, I mean, there's lots of reasons why I left, but it wasn't what I really wanted end of the day. But yeah, my bucket list item right now is, we're hiring people, I'm hiring instead of partnering in a lot of ways so that I can
love it.
eventually get to that point to where, I have this big investment firm and it's mine. So that is my big bucket list item right now is growing Streamline Capital Group.
I love it. I love it. Well, Brian, thank you so much. I really appreciate you coming on the show today. I think you brought a lot of value. You brought a different perspective as well with the long-term hold, which I think
Yeah.
was super valuable to the audience. So,
Mhm.
Brian, thanks so much for being on the show.
Hey, thanks for having me, Randy.
Absolutely. All right. And as always, to the listener, we encourage you to continue your education journey in this passive investing space. More importantly than that, though, make the decision to find a deal, find an operator, and invest in a deal. We're convinced that once you do, you will wish that you had started earlier on that path to decreasing your dependence on your W-2. So thank you again for joining us today. And we'll look forward to another great show next Thursday with another awesome guest just like Brian. Thank you.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.